Hey everyone, we're about to dive into something that sounds complicated but is actually the secret language of a company's health, profitability ratios. These numbers tell the real story behind a business, and by the end of this, you're going to understand exactly what they're saying. So let's get into it. So you hear it all the time, right? Oh, that company is super profitable. But what does that actually mean? Are they making a ton of money on the stuff they sell? Are they running a tight ship? Or maybe most importantly, is it actually a good place to invest your money? See, it's never just one number, it's a whole story. So here's how we're going to break it all down. We're basically going to follow a single dollar as it makes its way through a business. We'll start with the profit made right when something is sold, then we'll look at the costs of just keeping the lights on, and then the final, ultimate bottom line. And after all that, we'll switch gears and see what it all means if you're an investor. To keep things really simple, we're going to use an analogy. Let's just follow the money, step by step, through a business to see where it goes, and more importantly, how much is left at each stage of the game. Okay, so let's pretend we're running a simple bakery. All the money we bring in from selling cakes, that's our revenue. Super simple. Now, the cost of the actual ingredients, the flour, the sugar, the eggs, that's our cost of goods sold. And all the other stuff we need to pay for just to exist, like the rent for the shop and our baker's salaries, those are our operating expenses. Make sense? Awesome. All right, first stop on our money tracking journey. We're looking at the profit a company makes just on its core products. For our bakery, this is all about the cakes and pastries themselves, nothing else. And that journey begins right here with revenue from operations. This is just the total cash that comes into the register from our main gig, selling baked goods. This is our big starting pile of money. Okay, before we get too excited about that big pile of cash, we have to pay for our ingredients. That's where the cost of goods sold, or COGS, comes in. This is the direct cost of making the things we sell. Think flour, sugar, all the direct costs that go into baking each and every cake. So what do we have left after we subtract the cost of our ingredients from all the money we made selling the cakes? Well, that's our gross profit. This is the very first level of profit, and it's super important. It tells us if we're actually making money on each cake before we even think about paying the rent or the staff. But here's the thing, a raw number in dollars isn't always that useful, especially if you want to compare our little bakery to a massive corporation. That's why we turn it into the gross profit ratio. We just divide that gross profit by our total revenue, and boom, we get a percentage. This little piece of math turns a simple number into a really powerful insight. And this is why it matters. A high gross profit ratio, that is a fantastic sign. It means our bakery has a really healthy markup on its cakes and it's doing a great job managing its ingredient costs. It's pretty much the first big clue that we have a strong business model. Okay, so we know we're making money on the cakes themselves. That's great. But what about the cost of just running the bakery? Keeping the lights on? This brings us to the next chunk of our costs. And these are operating expenses. These are the costs you have to pay just to be in business. For our bakery, we're talking about the rent, our employees' salaries, any flyers we print for marketing, and even the value our ovens lose over time as they get older, which is a fancy accounting term called depreciation. Now listen up, because this is a spot where a lot of people get tripped up. There's the operating ratio and the operating profit ratio. The operating ratio looks at costs. It asks how much of our revenue is eaten up by costs. So for that one, a lower number is better. But the operating profit ratio looks at profit. It asks how much profit is our core business making. So for that one, a higher number is better. They sound almost the same, but they tell you completely opposite things. All right, we've paid for our ingredients, we've paid our rent, and our amazing bakers. Now it's time to get to the number that everybody really cares about, the ultimate bottom line. And that number is called net profit. This is it. This is the money that's left in the bank after every single expense has been paid. Not just the flour and the rent, but also stuff like the interest on any loans we took out to open the shop. And of course, you got to pay your taxes. This is the truest measure of whether the business actually made money. And you guessed it, we turned this into a handy ratio too. The net profit ratio tells us for every single dollar we made selling cakes, how many cents are left over as pure, clean profit. It's the ultimate report card for a company's overall efficiency. So far, we've been looking at our bakery from the inside, like we're the owners. But now, let's totally switch hats. What do all these numbers mean if you're an investor thinking about buying a piece of this company? And that really is the key question, isn't it? A profitable company is one thing, but as an investor, you want to know, what's my personal slice of that profit? And is the price I'm paying for a share of this company actually a good deal? First thing we look at is earnings per share, or EPS. It's not as scary as it sounds. You just start with that net profit number we found, you take out a small amount that might be owed to some special shareholders, and then you divide whatever is left by the total number of companies' shares out there. What you're left with is the amount of profit that belongs to each individual share. Next, we take that EPS and we use it to figure out the price to earnings ratio, or PE. You just take the current stock price of one share and divide it by the EPS. Now, this ratio is so powerful because it's really a measure of market expectation. It literally tells you how many dollars other investors are willing to pay today to get just $1 of that company's profit. Yeah, just look at this. Company B has a PE of 30, while Company A's is only 10. That doesn't mean B is a better company. What it means is that investors expect Company B to grow a lot faster in the future, and they're willing to pay a big premium right now for that potential. And finally, we have the big one, return on investment, or ROI. Think of this as the ultimate grade for the management team. It answers the question, for all the money tied up in this business, from the buildings to the equipment to the cash in the bank, how good is the company at turning all that capital into actual profit? A high ROI means you've got a team that is fantastic at making money with the money they have.
So let's do a quick recap. The gross profit ratio tells you if the products themselves are profitable. The operating profit ratio tells you how efficient the day-to-day business is. The net profit ratio gives you that final, ultimate bottom line. And for investors, EPS, PE, and ROI are the ratios that tell you what that company's performance means for your wallet.
You know, every one of these ratios is like a snapshot in time. It tells you how a company did in the past. But their real power, it comes from watching how they change over time and how they stack up against the competition. So I'll leave you with this question. Now that you have this toolkit, how would you use it to investigate not just where a company has been, but where it might be going next?